okay, with the introduction and what exactly audit is, and the most important is the summary of management's assertion by category. And the assertions which are for the transaction and events, and the assertions which are about the account balances and the related disclosure at the end of the period. So those one we're chasing at the end of the period are those presented. We're looking for existence with the rights and obligation, for the completeness, accuracy, valuation, and allocation, classification, and presentation. And on the event level at the time when the transaction happened. So that's how you should put it in your head. On the first one, we're chasing the day of the transaction event happened, where the next one we're chasing at the period end. So this one is for the transaction level. On the transaction level, this one is on the reporting level. And again, remember it, memorize it if you have to, and that's gonna pay back later. For all the level of assertions at the transaction level and at the reporting level at the period end. Then what's the objectives? Here is some example of objectives. And this is the fundamental concept that we already went through this. We went through the materiality of assessing the audit risk and collecting the evidence. And the definition of a very brief definition of the materiality, audit risk, and the evidence. The other thing that I'm chasing here is the audit reports. This is the audit report for which you're doing audit and only audit. So you're going to have unqualified report, which unqualified, the cost of unqualified means that because the financial statements are free of material misstatement, the auditor does not find it necessary to qualify his or her opinion about the fairness of financial statements because they're already fair. The qualified report is, again, the auditor find misstatement, consider material, communicate with the manager, and manager saying, no, I'm not changing anything. Or auditor is unable to get sufficient appropriate evidence regarding specific account. Then you can issue a qualified report. Adverse report is that's audit financial statement contain of misstatement. Now, when you look in the financial statement, there is some misstatement that you as auditor consider to be material. So when you're assessing the materiality, this misstatement is way above the materiality amount that you already assess. And that will be pervasively affect the interpretation of financial statements. So basically that affects the outsiders completely. So given the situation, we'll issue adverse opinion. And the worst opinion that you can ever issue, that's a disclaimer. So basically, there's a scope of limitation. Is so pervasive that's limit ability of the auditor to conclude on the financial statements as a whole. In that case, you just disclaimer of opinion. On some cases, you may even withdraw from the audit if you have to. That's with the chapter 1. That's the most important, most essential part from chapter 1. Now from chapter 2, what was the financial statement audit environment is the chapter 2. Again, on the chapter 2, I'll not test you so extensive. I didn't find it very much to test here. So the type of the auditors that we have: external, internal, government, and forensic auditor. And this is the type of the services the auditor doing. So for the audit service, here on the audit service, type of audit and assurance services, audit services, internal control audit, compliance of the audit, operational audit, and forensic audit. Assurance audit is the auditing of specialized form of assurance service, and tax preparation, planning services, management advice, compilation, and review services. Those are not audit services. This is the most common services that the auditor perform. This is the duties of the partners. There were some questions like that. I decided not to test on those one. That's the exposure on the scandals, how the whole the scandals going, and the overview organizational operations. This chart I found it kind of interesting. So you can see the overview of the financial operation, which start with the once you operational organization. So what you can see here is you finding the finances, the resource of financing. Again, you cannot start anything if you don't have finances. So either you have to invest money or you either have to borrow money. Once you have the finances, then you can start purchasing process. Then you're going to have your human resource management process. Then we have the inventory management process. Then you're going to start generating the revenue. And the revenue is going to give you finances, and you're going to start again purchasing, human resource, inventory management, revenue process, and keep going, keep going, keep going. That's what simply can find it. So now what we have to do is once we have this process in mind, so we have to stick with the idea which are the crucial parts in our audit. So first we're going to chase the source of, so basically we're chasing the cash. From where the cash coming, where the cash going. And then we're going to think about it of process of the organization and define those processes and start working on our audit on that area. This is how we're going to chase it is the revenue process, from where the money coming. And actually financing is the first, should be the first. But anyway, revenue generation is come after you have everything in place. Then you can start generating the revenue. But anyway, in the audit, you start first from the revenue, chasing the revenue. Then you're chasing the cash from the investors and cash from the creditors. Then we're chasing where the cash going on the purchasing process, see how the human resource dealing, and what's the inventory management. And this is the explanation of all these components. Anything interesting on this one is the standards. What's the idea with the standards and how the auditor should apply this ethics in the system. You know, the interesting part with the ethics system is before they merged in CPA, before the CPA merger, like 10 years ago now. It's like a long time ago. Seems like a long time ago, even though it was like only 10 years ago. So on that case, we have those three accounting bodies: CAs, CMA, and CGA. I purposely leaving CGA at the end. So the CAs, they never consider audit. No audit. They never consider ethic. And the CAs are the auditors. For their ethic, never been technical competency or anything like that. So they never consider audit as something important. Not audit, again, ethic, something important. CMA, those are certified management accounting. That was out of the three, I would say. I don't want to diminish anyone, but that was not the highest, let's put it this way, not the highest accounting body of that point, not the strongest accounting body. And CGA was the only one who considered ethic. And technically, on the ethics side, we put a lot of emphasis on the ethic. So let's go now with the audit planning, type of the audit test, and materiality, how we're assessing the materiality. And the phases of the audit is first with the client acceptance, preliminary engagement activity, and plan of the audit. So now we're chasing the options that we have when we start the audit in the very first place. And we have two options here. Either we're going to have a new client, either we're going to have the existing client. That's how everything starts. And then we start going through the process of first, if we have a prospective client, are we capable? Is the company complies with the legal or relevant ethical requirements, and consider the integrity? And then we're going all of those. If we have existing client, continuing client, we have to evaluate the client regularly. Basically, we're chasing for the events that might increase the audit risk. And near the audit, we can comply completion or after the significant event. We're going to see if do we have conflict over the accounts, and is there any disputes on the fees. So the preliminary engagement activity is to determine the audit, find the engagement team, and find the requirements. And then we're going to assess the compliance with the ethical and independent requirements on those. Internal audit, we're going to come back to this later in the next chapter to find out, is there any internal control in place? But how we're going to plan, preparing the audit plan should be guided by the results of the acceptance communicating process, procedures performed to gain understanding of entity, and the preliminary engagement activity. That's on what you're basing your audit planning of the audit. So when we start planning the audit, first will be assess the business risk. So put this one in mind, because again, once we start seeing each other, I'm going to give you, for the limited time that we're going to have, I'm going to give you some cases, and we're going to go over the cases so you can see actual application of the audit. And starting with the business risk, assessing the business risk, establish materiality, and is there multiple need of specialists. Those are kind of, you have it in mind, but sometimes you don't need to discuss those ones. Identify related party, consider additional value-added services, and document of the overall audit strategy plan in preparing the audit program. This is basically on the stage of the planning audit. Those are all the steps that you have to have in mind, even though only few are actually be discussed in the case. Again, to assess the business risk, you have to understand the entity, business risk of the material misstatement, and evaluate how the entity responds to those business risks. And then we're going to the different stages here on the, again, this is all for the planning of the audit. Materiality, how we're going to determine the materiality on the materiality. And basically, the first thing is, what is materiality? I want you to have this definition for yourself of the materiality. Why do we need the materiality? And what's the steps? First, to determine the overall materiality, which will be the planning materiality. Then we're going to determine the tolerable misstatement, which will be the performance materiality. And then we're going to evaluate the audit findings near the audit to determine which one is material, which one is not material. And how we're going to determine the overall materiality? By following this simple format. Again, you have to have in mind the quantitative, qualitative factors as well. Not going to spend on that one. The whole thing is just to go over briefly all those chapters to see that there's nothing scary, and you to ask me something. So once we assess the materiality, the risks. Now for the risk, which are the risks that we have. On the risk is that the auditor expresses inappropriate audit opinion where the financial statements are materially misstated. So this is the audit risk. This is the risk that the auditor may express inappropriate audit opinion when the financial statements are materially misstated. So basically, there's a problem with the financial statement. Auditor cannot catch it, and he expressing the unqualified opinion, where in fact he should express qualified opinion. That's the risk. And here we're going to have a two level of assertion. One is the financial statement, and the other one is on the account balance and disclosure level. Again, don't forget the level of assertions. Assertions about the transaction and events, and the other one is on the accounting balances and disclosures. So those are the three risks: inherent risk, control risk, detection risk. The first two, inherent risk and control risk, you may also see it as a risk of the material misstatement. There's nothing we can do about that. We can just assess it, but that's not that we have control over. The only thing that we have control over is the detection risk. And that's related for the sampling and what kind of sampling we're doing. And then we're going over the engagement risk during the engagement, what kind of risk we have. And the simple formula is that the audit risk is equal to inherent risk time control risk time the detection risk. And how we're going to determine the detection risk? Audit risk that we're chasing divided by inherent risk time the control risk. That's gonna, once we have the detection risk, where the detection risk should be, that's gonna give us idea. If the detection risk is too high, that means we have to put more procedures. If the detection risk is low, that means we don't need that many procedures. And that's how we're coming with this chart here on the assessing the detection risk. Remember this idea and keep it in mind. So again, the audit risk at the bottom is equal to the risk of material misstatement, which is inherent risk time control risk time the detection risk. So once we assess the entity business risk, once we relate those risks to what can go wrong, once we assess the material misstatement, then we can start focusing on the detection risk. Let me see what's here, going over the each of those risks and how we're gonna focus on one or the other, and what we have to do and what we have to do, what we don't have to do. Again, we're going to the risk of material misstatement and the intentional misstatement, or which can happen in the company. And then we're going to the fraud risk assessment process. And is there a fraud that might exist in the company? And don't forget about the fraud. We have to have the three elements in order to have the fraud. We have to have a motivation, we have to have opportunity, and we have to have a realization. Now, in order you to identify is there fraud, and if the fraud exists, what you have to chase is there motivation, is there pressure, is there any incentives for the organization to do something inappropriate in order to satisfy those incentives or to release that pressure. And the pressure can come from the inside or from the outside. And that's about the fraud and the process of detecting the fraud. The next chapter was chapter 5 was evidence and documentation, how we gather those evidence and documentation. So we have on the financial statements, we have so the whole idea of the audit is, first what we're seeing is the financial statements. So the audit report is going to tell us, are those financial statements actually correct? Do they actually represent the real picture in the company? Did they represent what actually happened in the company? Now, in order to write this report, first we have to find the management assertion about the component of the financial statement. Then we're going to put the audit procedures in place to provide the evidence on the fairness of the financial statements. And once we reach the conclusion on the evidence, we can issue the audit report. Which are the management assertions? Again, we have on two levels, on the transaction level and event level, and on the account balances level. Again, remember it at the day of the transaction first and at the reporting date. One is related only for the period under the audit, assertion about the transaction related disclosure for the period under audit, and then assertion about the account balances and the related disclosure at the period end. And then we're going to have here the examples of the categories of assertions. And once the first column chasing the transactions, the second chasing the account balances. And here you can see on one slide, actually on two slides, all the definitions of the level of assertions that we're chasing. How are we going to gather the audit? What's the regarding to the audit evidence and how we gather that information? We're going to chase the nature of the audit evidence, sufficiencies of the appropriateness of audit, and evaluation of the audit evidence in order to check the management assertion. And this is the audit assertions through this Canadian Accounting Audit Standards 315. And this is the explanation now, which one is sufficient, which one is not sufficient. Remember, the appropriateness and measure the quality of the audit evidence is how we're going to measure the quality of the through the relevance and reliability. Why I'm telling you this, because probably this is going to be tested for some of you. Now, how are we going to evaluate the audit evidence? By the type of the evidence available and by relative reliability of the available evidence. On the audit procedures, we're going to have a risk assessment procedures, test of the control, and substantive procedures. And those are some examples of the audit procedures for the assertions, level of assertions that we're chasing. I'm chasing something more general, something more crucial. Audit documents. Now, what should be the content of the audit documents to demonstrate how the audit comply with the auditing and related professional practice standards, support and understanding of the accounting records. Also, we're including the written audit program and enable our knowledge and experience related to understand the nature of the business and determine who perform and review the work. We're going to have two types of files, permanent file and the current file. Permanent file is the file that we're going to keep all the time about the company. The current file will be only on the audit that we're actually doing. Those are the example of the account analysis working paper. What else I wanted to see on the analytical procedures, so the risk assessment, substantive analytical procedure, and final analytical procedures. Those are the one. Expectations and tolerable. Those are when we have more than tolerable differences. Again, the tolerable differences will be depends on the materiality. Once you establish the materiality, then we can see which one is tolerable, which one is not tolerable, and also the ratios that you might chase in order to justify the financial statements are actually free of errors. And the last thing that we did, it was on chapter 6 on the internal control and how we're assessing the internal control. That's why previously I didn't talk about the internal control, because everything basically is in this chapter. Internal control system is why do we need that internal control system? Obviously to reduce the control risk. To make sure that actually not to reduce the control risk, more likely accurate statement will be to make sure that the control risk actually is on the level that we are okay. Which are the objectivities here? Reliability of the financial reporting, effectiveness and efficiency of the operation, and compliance of the law and the regulations. And then we're going to start working over those one. And we're going to start chasing first the information technology of the internal control. What's the benefits and negative? Component of the internal control. So the component of the internal control, I want you to know those one is the control environment, entity risk assessment process, control activity, information communication, monitoring activities. And this is the brief explanation and definition of the component of the internal control. Those are the principles. There are a lot of principles here. 7 planning the audit strategy. Again, the planning of the what will be the hour to assess the control risk. Again, there's nothing we can do about the control risk. It's only to actually to assess it. And also substantive strategy for actually testing the control risk. Everything is related to the assertions level. Assertions, management assertions on here we have the on the transaction and events. This is the case that we need IT specialists. Why do we need IT specialists? Because we might not have enough experience, or something new happen, or the company implement a new software which we don't have expertise on that one. On that case, we can ask and obtain financial IT specialists. In which cases we don't need a financial IT specialist is when we are familiar. There's no changes in the current software, current IT system in the company which we're familiar. We already been tested. There's no changes. Everything repeating. The controller in the company put enough control procedures in place to satisfy any control risk that might happen with that, internal control risk that may happen. And this is the obtain the understanding of the internal control, to understand the control environment, understand the entity risk assessment process, understand the information system communication, control activity, and understand a monitoring of control, how they're monitoring the control. Where were those one? Were they here? Let me see. Are they the same? Yes. Those are the 1, 2, 3, 4, 5 level of components of the internal control. And this is the objectives why we need those level of control. So which are the limitations of entity internal control? Is the management override of the internal control. So there might be control procedures in place, but the management tend to override them. by following the procedures or doing something against the procedure, or not simply not following the procedures. We may have the human errors or mistakes, and we have the collusion that with the more than people working together. So this is the internal control weaknesses which are observed by the CFE. Which one is the most override of the existing internal controls is the one of the biggest chunk, or lack of the internal control is the biggest chunk if we have to talk about this. Lack of the management review, so there's a process in place of management not reviewing, or poor tone at the top means that fish always smells from the head. A lack of the competent personnel, and lack of independent check. There are always going to be some others, which is the very gray area here, which exactly those ones. And how we're assessing the control risk. First, we identify the specific controls that we're going to rely on, perform the tests of those controls, and we're going to conclude on the achieved level of the risk control. So again, put this one in mind, because this is the actual process. First, identifying it, then you test it, and then we make conclusion. So that will be the approach that you writing the assurance questions, when you're solving the cases for the assurance. Identify the risk, or identify what you have to look at, then perform the test, check if this actually weighs it. So if this is the risk, let's say we are thinking that there's a business risk related to the controller, then we're gonna do test. So let's say the situation, let's go in with this situation where there's a company change the controller, and the new controller just step in place in the middle of the year. Is there risk, business risk? Yes, that increase the business risk. So what we have to do is the new controller has the ability to perform the same duty that the old controller did, and is the new controller actually increasing the risk in the company or reducing the risk in the company? So that what we're going to do, we're going to perform test of the control. What will be that? Probably we're going to chase what's his background, what's his understanding about the business, does he have an experience, does he have an experience with this type of businesses from before? Where is his diploma, what's his GPA? I'm joking, right? We're not going to test those one, obviously, but at least we have to get some idea where the new controller is, what's the level of the new controller. Once we do that, then we can conclude is this increase the overall risk or actually reducing the overall risk, and how this help on the control risk in the company itself. So here we'll be performing the test of the control. Will be identify the appropriate entity personnel, observation of the application of the control, inspecting the document indicating performance of the control, and performance of the application of the control by the auditor. What was the important here is that always the document from the third party worth way more than the document directly obtained by the company, or the internal documents from the company are less, how can I say, less reliable than the third party documents. We have the timing of the audit procedure. So the timing of the audit procedure, we're going to have interim audit procedure. We're going to have the year-end audit procedures. The interim audit procedure will be during the year. First, we're going to start with once we're going to start understanding of the entity and the environment, and plan the audit during the year. We're going to do some interim test of the control to make sure is there control in place, which is going to affect that our audit procedures at the end of the audit. Then when the financial statements are released, then we start conducting the substantive testing based on what we find out about the control risk and where the control risk is. Interim test of the control and interim substantive procedures that we may have in place in order to satisfy and be comfortable with the level of the audit risk. What's next one is the type of the control in the IT environment. That will be related to the IT system, which are the general controls and which is the application of the control. Why we have the general control, what we're achieving through that general control. That's how we should look this chart. And that was about this chapter 6. Now that opened the area for us to go further in this textbook. And we're going to start, first we're going to start with the auditing internal control over the financial reporting and how the internal control actually is going to help us during the audit. That will be chapter 7. And let's see what else, what's happening with chapter 8. Now we're going to start doing audit sampling and overview of the application of the test control. That's become a little bit more interesting when we come into the sampling. So let's go briefly over the chapter 7. And during the overview of chapter 7, I'm going to see how important is that chapter is, what will be the area of the testing, and I'm going to tell you what will be tested on that chapter. And then we're going to move to the chapter 8, which is more interesting when we start dealing with the sampling. Because when we go to the sampling level now, that's a little bit more practical, and then we have to start thinking about what exactly we're going to examine within the different processes. And then you're going to see later when we go to the, at some point we're going to start with this overall theory, and we're going to start digging into the cycles, revenue cycles, financial activities, and purchasing activities. Then we're going to graph human resources. Then we're going to see the inventory management. And I want you to have idea about those activities that are object to the audit. So let's see now that very briefly here on the management responsibility in Canada, why the management responsible require management of the publicly traded, we're talking about here publicly traded company, which are subject to audit. Private corporations, those are not subject to audit. And it doesn't make sense, the private corporation, to spend the enormous amount of money to get an audit report. Private corporation, they're usually doing the compilation. And that will be the highest level of assurance that they're going to get. Unless that private corporation not thinking to go to a initial public offering, IPO. So let's see now, require management of publicly traded company to issue a report that certifies the effectiveness of the internal control. Now we're putting more pressure on the management and they to certify that, hey, we have internal control in place. Do they have or not? That's a different story, but at least they come up with this report that certifies. On the United States, was the United States, those are the United States responsibilities. Let's go with the internal control deficiency. Which are the internal control deficiency? First deficiency is control deficiency. Exists when the design or operation of the control does not allow management or the employees in the normal course of performing their assigned function to prevent or detect misstatement on the timely basis. What's the timely basis? That's a very kind of subjective. Timely basis can be a week or can be a month, can be a year. Now, significant deficiency is the control deficiency. So again, we're talking about if something goes wrong, which is the deficiency. Is a control deficiency or combination of the control deficiency and internal control over the financial reporting that is less severe than the material weakness. Yet, but it's important enough to merit the attention of those responsible to oversee the company financial reporting. So something below the materiality, but still enough to drag our attention. Which are the internal control, how those are defined? Those are the deficiencies that may be serious enough that is to be considered not only for significant deficiency, but also material weaknesses in the system of internal control. Material weakness is a deficiency or combination of deficiency, such as reasonable possibility that material misstatements of the annual internal financial statement will be not prevented or detected on the timely basis. So we have some mistake, which mistake cannot be found on the timely basis. So let's go with the, so to illustrate the next slide, the auditor must consider two dimensions of the audit deficiency. First will be how likely that was. Is it reasonably possible? And what's the magnitude? Is it material? Is it not material? Is it significant? Is it insignificant? So now you can see here the level of how we define the level of the mistake, of the magnitude. This is also important for you to understand. So we have insignificant, which is the very low type of mistake or deficiency, or the magnitude will be insignificant. Basically, that's not going to affect our opinion. We're still going to issue unqualified opinion. Then we have a significant, is the next level. Significant. It's not material, but it's significant. And the next one is the biggest one, is the material. Now, which material now we're hitting? Is it hitting the overall materiality, or you hitting the performance materiality? That will be another question. So even if we have a material misstatement on the financial statement, that's not enough evidence we to issue a qualified report. We can go with the unqualified report, and unless the management decide not to do any changes or any adjustments on the proposed adjustment entry that we're giving to the management in order to eliminate the effect of the material mistakes. So let's see now what a control deviation caused by the employee performing control procedures that he or she is not authorized to perform is always considered what will be that one. Deficiency in design, deficiency in operations, significant deficiency, or material weakness. That's what we're chasing here. Now we have again control deviation caused by the employee performing control procedures that he is not authorized to perform. Obviously, that's not going to be deficiency in design. It's not going to be deficiency in operations. Now we're chasing of the material weakness and significant deficiency. Since we're talking about deficiency, most likely will be the significant deficiency rather than material weakness. or maybe of deficiency in operations in this case.
In
What do you think?
operation. I think
Deficiency in
this,
operations?
yeah, I think
Let's
so.
see what will be the answer. Yeah, deficiency in operation will be the correct one. Obviously, that's not going to be significant deficiency. Design, there's nothing that actually this we are on the level of the performing rather than designing the. So let's see the magnitude again. Control deficiency is the very low on not materials. Non-material but significant is the significant deficiency, and material is this is the highest level of the magnitude. And now we have the magnitude, how high is it, and the likelihood. How likely is this to happen? If we have the control deficiency, then we're going to report to the management. If we have significant deficiency, we're going to report to the audit committee and to the management. And if we have the material weakness, then we're going to report externally. That means in our report, we're going to communicate that one with the external users. Now we're going to the external. We're going to communicate with the audit committee and the management. So you can see the who is to whom we communicate the deficiency based on the magnitude of the deficiency. Like you can see here, just internal to the management. Here still internal, but we're involving now the audit committee. And the last one is we have to inform the outstanding users that, hey, there's a problem here. So management assessment process, how we're going to assess the management. Identify the financial reporting risk and control. Consider which location to include in that evaluation. And evaluate the evidence of the operating effectiveness. Again, we're going to identify the area. We're going to start chasing that area. And then we're going to evaluate the evidences about that effectiveness. Now, the most entity, we're going to use the framework defined by COSO. I have no idea what's the COSO. Let me see what COSO is.
The control internal. Is the control internal control process.
Just give me a second. I'm going to tell you.
Yeah.
Committee, no, no, that's not. In audit, what's the COSO?
Is organization that create that type of
Control
internal
environment, risk assessment, control activity, information communication, and monitoring. So there's a okay, we talk about this COSO, but I cannot see exactly what the COSO means. What's exactly the abbreviation of COSO?
Is committee
Committee
of
of
the
the sponsoring Trade Water
organization
Commission, right? Yes, I
of the
have. It's a
trade.
private sector. It's a private sector initiative, the American Institute of Certified Public Accountants, Institute of Management Accounting, Institute of Accounting Association, Associated. COSO is the internal control integrated framework, which somehow overview of the COSO. Okay, so there's a, my God. How can you not love audit, huh? Always give you something that nobody knows what is that about.
Yeah.
Out of nowhere, we start talking about COSO. This is the COSO. Have you seen COSO before?
Yes, is the in the control internal control. This this committee determined the 5 levels of internal control
Oh, right.
that we
Yes.
see before.
Yes. So that will be in here in chapter 6. You're
Oh,
talking about when we're talking about
chapter
the
6, yeah.
right. We're talking about this one.
Now, what's in chapter
Here we go. That's the one.
5?
No, chapter 6.
6,
Chapter
yes.
6. This is
6,
the component
yeah.
of the internal
This
controls,
one, yeah.
right? So in the corporate on the component of the internal control, we have the control environment, risk assessment, control activity, information communication, monitoring activities,
Yes.
right? And then we have to change them on the operations, how they operate, how they are reported, and what's the compliance with the all the but COSO as a term, I don't think we have seen that one anyway on the slides. It wasn't introduced anyway on the slides, was it? At
No,
least
just put
just there, but
the
we
name.
have to, yeah, we
Yeah.
have to take it out
Yeah.
from here. Okay, interesting. Let's continue with our COSO thing now in chapter 7. Let's go back to COSO. Is a framework that the 3 primary objectives in the internal control: reliable, efficiency, effectiveness of operation, and compliance of the role. So what's the purpose, what's the objective? So once you take a look at the, in order we to understand the anything, we have to find the objectives. Put this one in mind, and you can get this idea somehow from the management accounting. In the management accounting, that's what we're chasing first. We try to find what's the objectives, and then we're going to find out what's going to happen after. So once we know the objectives, so the three primary objectives, the internal controls are to produce a reliable financial reporting statements. Second, to have efficient and effective operations. That's why we need the internal control. Because if we don't have that control, you're not going to have efficient and effective operation. And the last one is to comply with the law and the regulations. So, for example, I'll tell you internal control for the extended scope of management on the level of compliance of law and regulation. What will be that? Internal control.
Repeat the question, please.
Sorry, internal. Let's think about it. If the objective of the internal control is compliance with law and regulations,
Yeah.
now we are assessing extended scope of management.
Yeah.
What will be inside
Why?
that objectives? Yes.
I need to check. I think their
Let's say we're doing
objective
audit.
goals, procedures, manual of procedures, and the
No,
control.
think about it. Think about it. What will be the in extended scope of management if we have to test the third objective, compliance with the law and the regulation? What exactly we're gonna look for?
I need to check if they require the certificate to teach, like with the government, to ask
Okay.
for this
So
document.
but that will be on the level of the instructors, right?
Yes,
Let's
the
go on
level of
the
structure there.
first let's go first on the level of the company.
Yes, we
What
need
kind of law they have?
to
Yes.
check if they have the authorization for the government
Okay. Which
to
government we're
teach.
chasing? We're chasing specific government. Be specific here.
For the
Ministry of Education, right?
Yes, for education, Ministry
Ministry
of
of Education.
Education.
So what we're gonna chase is the program that they deliver. Is that program meet the requirements for the Ministry of Education?
Yeah,
What's the program that they deliver now? Bachelor,
about the
right? So
management,
so,
business of management program.
management, but it's still in the bachelor because at the end, once you finish the extended school of management, you're gonna end up with the bachelor degree. Now, what the
Yeah,
concentration is, that's a different story, right? But you're going to end up with the management of what will be that? Management of business management?
I think so.
Business
Yeah.
management with concentration in accounting. So what we have to do is this, whatever the degree they're providing, is this compliant with the laws, which law of ministry education and regulations, which will be the secondary regulation that they have to do. So once we have the that will be accounting concentration. That means this program that they deliver have to meet the requirements of the accounting association to which
CPA.
they like providing these courses. So what we're going to do, we're going to check, is this school actually approved by that association, and that will be enough evidence for us. Now so once we see that they comply with the law and regulation, then we can gonna go on the individual level of the people who actually are performing the services.
Yes.
Do they have requirements? Do they meet the required law and regulation for that level they to provide the service that they're providing? For example, is the teachers have a master's degree for the post-secondary, because on all the post-secondary institution, and one of the requirement of to be the instructor is you to at least to have a master's degree, or to be have the professional qualification for the course that you're teaching, means that you're a member of the professional body with the requirement experience, so you can actually deliver the courses. So basically we're chasing here for the academic plus the practical experience.
Yes.
So right, once we find this one, then we have to see how efficiency effective this operation work.
Yeah.
What we're gonna do now, we're gonna start digging on the level of the first in the program,
Yes.
how the program is delivered, what's the requirements. So basically, if the program allows the student to take intro managerial accounting and advanced managerial accounting in the same semester, mostly the efficiency and the effectiveness of the operation, it doesn't exist. All right.
Yeah.
So you can see how, based on the nature of the business and understanding of the business, you can start developing and start assessing the internal control,
Yeah.
or the objectives of the internal control. Make sense?
Yes.
Okay. So now what will be the example of the entry level control? Control with the within the control environment, tone at the top, independence of those charged with the governments from the management, assessment of the authority and responsibility. So basically, if we have to chase how independent is the let's say example will be the former accounting director with the instructors, then we can see that the whole thing in Extender, it doesn't meet any requirements, because there's no independence here. In the contrary, there's a related parties involved, which jeopardize that put in risk the effectiveness of the operation, that put in risk requirements with the law and regulations, that put in risk the entire accounting concentration, because one person has a personal interest, which personal interest is how can I say, that will be that's we can even go with even deeper and to see, is there a fraud in the whole system? Well, obviously there's all the elements of the fraud are met, because we have incentive, we have a personal interest, we have opportunity present itself, and then we have actual realization. So that's on that level is very interesting thing. So next thing is the control over the system override or bypass. So this is if you have the entry level control. Entry level control means that on the level of the entering the transactions in the system. So the control of the control environment, consistent procedures, policies over the attracting and training over the performance appraisals, entity-wide programs such as code, conduct, and fraud prevention. So basically, we're chasing within the control environment, do we have enough control in place so we can say that, hey, there's a control over the entry process of the entering the journal entries. Then we're going to see what's the control over the system override and bypass. So what that means is if the junior accountant can pause the transactions without approval or bypass the process of the approval, then obviously that element of the control doesn't exist. So now you see how we assessing the risk. So the risk will be, is it possible the junior accountant, what's the risk of the override or bypass the authorization? Then we have to collect the evidence about assessing the control. So we're going to go to the users which have access to junior users and see what kind of authorization and what kind of level of access they have to the accounting system. Once we find enough evidence and once we document those one, then we're going to make a conclusion about the risk and the possible how this outcome of what we found can affect our audit work. The next one will be the entity risk assessment process, how the entity assess the whole process, control to monitor the results of operation, control to monitor. Those are the, again, examples that you can come up with and you should be able to come up with. Now, as you can see, audit, it's start getting, now with trying to link, I'm trying to link now the theory with the actual application, with the actual functions in the company. So on this level, what I want you to do is, if you have experience, that will help you to start seeing the things. But if you don't have experience, then I have to rely on your imagination. Now, the other thing is what I strongly suggest you, if you don't have experience and you feel weak on the experience, naturally you won't be able to come up with the ideas of the how to test this and how to test that and what exactly to focus on, which is fine. Why is fine? Because you have cases. We have cases for the different industries, for the different companies, for the different type of organizations, which if you read the answers, you can equip yourself with enough samples that if something happen or some similar things happen, you to use those samples as guidance to find the appropriate procedures to put in place when the case comes, right? So the point here is you to understand that if you have a gap somewhere in the process of theory, actual application, experience, you can also fill those gaps if you want to. Again, this is very conditional. Only if you want to. If you don't want, you don't have to. But then if you don't want to do it, then you have to suffer the consequences of having a case which you see it for the first time and you have no idea about the business and you're wondering what you did now. You know, I'll tell you this. One of the aspects when I was working for the landscape architecture company is the arborist. Arborist is that's a learning about the tree and how the tree growing and everything like that. So because I was kind of interested in the arborist, and I find it some kind of very interesting. Yeah, I can say very interesting in terms of uh, understanding the trees, and because the trees is a living organism, even though it's not like doesn't have, maybe we think we don't have a soul, but we don't know that. So, but anyway, it has so many requirements for different type of tree, for different type of location, how this done, how is that done. Why I'm telling you this? Because one of the cases that I have on my exam, I still remember that exam in CGA, was about the forest company. And my extra knowledge on the arborist actually helped me to come up with the ideas of the possible fraud that may happen in the company. So that's why I try to equip yourself with the more knowledge about different industries. You don't know on which case what you can use. So management documentation. Let's move on for our stuff here on the management documentations. Must develop sufficient document to support the assessment of effectiveness and internal control. So what will be the sufficient documentation? It's very broad area now, right? So if you say, I have control over the inventory, show me your documentation. Well, we have a purchase invoice and I have a sales invoice. Is that going to be enough to show me that you have sufficient documentation to support the assessment of the effective internal control over the inventory? What do you think? So let's think about it. Inventory. We're trying to assess how effective is the internal control. We ask the management for documents. What kind of documents you have for the inventory? And the management tells you, well, we have a purchase invoice, which shows what was purchased, and we have a sales invoice. Now, the question is, we as an auditor, can we say that we have sufficient documentation that actually supports that the effective internal control over the inventory? What do you think? Do you guys get the question?
I think, okay, I'm not sure if I understand the question, but I think to consider that this is sufficient documentation, we need to check not just the invoices for the purchases and sales, if not the control for the inventory and the system that they are using, and checking even though physically something.
Right. So listen this. So now, obviously, yes, that's not sufficient documentation. Of the purchase invoice and the sales invoice, that's not sufficient because you're missing the whole point here. You just seeing only the point of the purchase, point of sales, but you're missing the midpoint. What will be the midpoint? Let's start first from the very beginning. First, what we have to do is if there's inventory then and there's a purchase inventory, we have to find if the system and if the records shows that there's a purchase order which is signed by the person who purchased it, approved by the manager, which purchase order was placed, then that purchase order, when the actual order came with the purchase order that's coming, the goods that was shipped plus the invoice to justify. the shipment. Then we're going to have on the warehouse, there will be a warehouse clerk who actually accept those items and put them in the warehouse. Then there's a requisition form from the warehouse, from the person who actually doing the sales. He required those items to be pulled out from the warehouse. And there's a form that shows that things going in the warehouse and going out of the warehouse, which is supported again with the documentation. Then that requisition order is attached to the sales invoice. And then we can see the shipment of the goods leaving our company, premises of our company. That will be considered sufficient documentation. So now with this document, we may form such as paper, electronic files. Electronic files, we have all the documents recorded also in the accounting software or other media. This might also include the policy manual, process models, flow charts, job description, documents, and forms. As you can see here, the areas of the documents that I give you examples is very broad. Why? Because we're not going to test only the inventory. This one we're going to apply for the, if we have a service company, and the company actually perform educational services, we need that job descriptions of the people and the qualifications. So now let's see how we're going to integrate audit of the internal control and the financial statements. So now the integrated audit is composed of the audit of internal control and the financial statements. Now the control testing, we're going to impact the planned substantive procedures. So we're going to test the control, and if we find the problem with the control, with the internal control, that's going to impact how much effort we're going to put on our substantive procedures in order to reduce the audit risk. Because remember, we cannot on the control risk, we're only assessing it. And if we don't find enough evidence to support that our control risk is low, and we end up with the high control risk, that means we have to modify our detection risk. So in order to reduce the detection risk, we have to put more substantive procedures. Also, the result of substantive procedures are considered in the evaluation of the internal control. So once we're testing the internal control, we're having in mind what kind of procedures we have to put in place when we actually start testing the financial statements. So how are we going to do? Step of performing the audit, plan the audit, identify control, internal control financial statements. So plan the audit for the internal control financial statements, identify the controls to test, which control we're going to test. Are we going to test control over the inventory? Are we going to test control over the journal entry? Are we test control over the authorization of the journal entry? That's a different story. Then we're going to evaluate the design and the test of operating effectiveness of the selected control. Once we select that control, we're going to evaluate how that control is designed and how that control is tested. And once we do that, we're going to evaluate the identify control deficiency. If we find any deficiency, we're going to evaluate those deficiency, and we're going to make a conclusion based on that. So let's go with the planning of the audit. First, we're going to start with we're going to consider for role of the risk assessment and risk road, scaling of the audit, and using the work of the others. So using the work of the others, what will be the others? That will be the controllers or somebody from the company, what kind of documents they have. Special consideration will be using the work of the others. That will be evaluate the nature of the control subject to the work of the others, evaluate the completeness and objectivity, and test some of the work. So first, as you can see, I always end up with test. And once we do the test, then we're going to evaluate the quality effectiveness of the work. So first, we're going to evaluate the nature of the control. So we're going to identify areas of risk. Second, we're going to evaluate how we're going to gather evidence, how those are completed and objective. And the next thing is we're going to test them. And once we do the testing, we're going to evaluate. As the risk associated with the control and being tested increase, that means we have to do more work. Every time when we see increase in the risk in the company, that means more work for the auditors. So how are we going to identify the controls to test? Identify entry level controls, identify significant accounts and disclosure, understanding the key sources of misstatement, if there's any, and then we're going to select the controls to test. We're going to identify now, depends on what we're looking for, which cycle we're looking for, we're going to test different accounts. Now, to identify the significant accounts in disclosure, we're going to the following risk factors. First, size and composition of the account. How are we going to find out about the size? Well, remember in the very beginning, we put the materiality. If that account follows under our materiality, now we're going to have a overall materiality and performance materiality. If it falls in one of those, then we have to test it. That's going to give us the size and composition of the account. Second one will be susceptibility of the misstatement due to error and the fraud. We're going to suspect, is there any possibility of error or fraud within that account, which we already selected. Then we're going to check the volume of activity, complexity, and how homogeneous of those individual transactions processed through the accounts or reflected in the disclosures. So we're chasing on the account level and on the disclosure level about activity, complexity, how homogeneous, that means are they in the same type. The nature of the account and disclosure, and accounting and reporting complexity, how complex is this one associated with the accounting disclosure. More complex, more testing. More complex, more risk, more testing. Less complex, less risk, less testing. Also, we're going to check the exposure to losses on the accounts. If we see losses, obviously that's a red flag right away. We have to see, is this loss actually happen? Possibility of significant contingent liability arising from the activity related to account disclosures. So when we have a contingencies, we have to understand what the contingency is, then what the contingency liability account is, and then we're going to start chasing those accounts. Existence of related party transactions in the account. The party transactions are going to be considered anything related to the not only third parties, but anything related to the idea of arm's length. Changes from the prior period in the account and disclosure characteristics. That's why auditor usually at the end of the period, they comparing the final ending balances of one period versus another period. And if they see significant changes, they start chasing those accounts. Which are the sources of misstatements? To understand the likely sources of the potential misstatement, the auditor needs to do the following: understand the flow of the transactions, identify the points, identify the controls, identify the management is implemented or the prevention or timely detection. And then we're going to start with the selecting the test. Those will be the factors when they identify the control test. As you can see, getting a little bit heavier here, but if you put it in the logical order, everything makes sense. Now, do you have to know all of those? I mean, those are written here because they're coming from the practice. But in practice, you already put all those procedures in place if you're a controller who pay attention to details. Because at the end of the day, you want to have clean and fair financial statements. Now, evaluate the design operating. How are we going to evaluate the effectiveness of control? We're going to test and evaluate operating effectiveness, the nature, the timing, and the existence. Now, let's see, suppose the entity implements control whether its sales manager review and investigate a report listing sales invoices with unusual high and low gross margins. Would inquiry of the sales manager as to whether he or she investigate discrepancy be sufficient evidence to ensure that the control of the working effectively? So now we're supposing that the entity also already implement control where the sales manager review investigate, so the report is prepared which listing the sales with unusual high and low gross margins, and there's a manager who review investigate that report. Would that inquiry of the sales managers as whether he or she investigate the discrepancy will be sufficient evidence for us that control work effectively? What do you think? Do you understand the question? The question is very the level of the question is the level of the way that the question is presented is kind of confusing, but do you understand the question first? And second, what do you think? Are you guys with me? Did I lost you? Hello? Can you guys hear me?
Hello, Prof. Yes, yes, you can still hear.
Yeah, we can.
Yeah. So what do you
I
think?
think, I think the auditor maybe can check the report that generate in the internal console and check if the action was doing that that the report says, like, I don't know. Mm, They need to check, the auditors need to check if the uh, information about the other procedures that they are doing to checking the report and everything. It's enough information.
So technically, what says the suggestion is no, that won't be enough evidence, right? That won't be sufficient. We're talking about sufficient evidence. That won't be sufficient evidence. That will be a good starting point, but after that we have to find other areas. Now, what will be that? That will be we're gonna take a look at the management responsible for performing other procedures such as inspecting the report generated by the performance control, whether appropriate action were taken. So basically, only the inquirer sales manager, whether he investigate discrepancy is not going to be enough. We want to see when he find the discrepancy, is there any follow-up action, and what exactly is the process in place. So just one simple thing is not going to be enough. We're also going to chase something else. Let's see identifying the control efficiency. That's another here the example of the likelihood and magnitude of the control deficiency. Here we're talking about the risk factors which affect the control deficiency or misstatement of the accounting balances disclosures. So that we chase the nature of the financial statement accounts, the suspectability of the related assets and liability, suspected complexity and the extent, interaction with the control with the other controls, and with the deficiency and possible future consequences of the deficiency. If we find deficiency, what will be the possible consequences? And here the indicators, the material weaknesses. Remember, the material weakness is the one that's going to change our opinion. Now, remediation is the process of correcting the material weaknesses. So remember, in order to issue unqualified opinion, once we find the material misstatement, we have to ask the management to change or to fix those mistakes. If the management refuse, then we can issue qualified opinion. But if the management is collaborative and they're okay, we're gonna do those changes, whatever you're proposing, then that's a reason for us to issue unqualified opinion. The auditor should document the process, procedures, judgment, and results relating to the audit of the internal control, which is consistent with the audit quality documentation standards. How are we going to use on the service organizations? Since most of the company now doing services, if the service organization services make up the part of the company information system, then we can consider part of the information system and communications component of the company internal control over the financial reporting. And then in this case, the management auditor should perform the following procedures: obtain the understanding of the nature and significance of the services provided by the service organization and their effectiveness to their entity internal control, which are relevant to the audit. Design and perform the audit procedures to respond to those risks. So first, again, remember this, we trying to understand the business, the nature of the service, the nature of the internal control. Then we're going to assess the risk of the material misstatement. Once we do that, then the next step is to start design and perform the audit procedures based on the risk that we already identify after we obtaining the understanding. Safeguarding of the assets. Which are the safeguarding of the assets? That will be the policies and procedures which are put in place to provide a reasonable assurance that the assets are actually safeguarded. in terms of unauthorized acquisition, use, or disposition of the entity assets. Computer assisted audit techniques. That will be computer assisted audit techniques, CAATS. If you see from now on CAATS, that means computer assisted audit techniques, including the generalized audit software, which is caseware, custom audit software, if there's the auditor using their own software, and test data. Now, those generalized
Okay,
audits,
Professor,
yes?
what are the best software for audit? Or what type of audit software of audit are more using in Canada?
Which one is more used in Canada?
Yes,
Caseware.
caseware.
Caseware. Most of the,
And we
pretty much all the companies in all the small and medium audit companies, or they're not audit. Don't get me wrong here. Very few companies qualify to do the audit. And if you want to do audit, you're not going to go to some public practice company which have 10 employees. You're going to go with the Big Four or Big 10 or the next 5 or something like that. But you're not going to go to small companies, and the small companies usually they don't qualify to do the audit. So but all the companies using caseware, mostly
we
caseware.
we need a certificate to get this
The
software.
caseware?
Yeah.
No, you don't need certificate for the caseware. If you want to start with the public practice company, I don't think anyone expects you to have previous. If you are new there, and if you're coming directly from the you study, let's say from the college or from the school, they don't expect you to have previous knowledge on the caseware. That's why it's very friendly user software, and they provide the training for that. So you don't have to worry about knowledge of the caseware. Now, if you're moving from one company to another company, then yes, they probably having caseware and knowledge of the caseware, that's definitely going to help you. The other thing with the audit is once you finish your study and when you apply for the public practice company, you usually will be treated as a junior accountant, unless you have something very unique and experience from before that put you on the level of the senior. But because of the seniority of that company, most likely you're going to start from the entry level, and then you're going to start building up.
Okay.
Right?
Yeah.
Now, you have to be, how can I say, you have to be realistic here, especially applying in the public practice company. Means that even if you apply for Big Four, you have to be realistic, and you have to understand the nature of the market and the nature of the company and why they're hiring. The only reason the audit company hires students directly from the school, accounting students from the school, is because they want cheap labor. They want young people who are eager to work, either to get interaction with the other young people, and they're willing to work 10, 15, 10, 12, 15 hours a day during the tax season. The other thing that they're chasing is they're not chasing random accounting students. They're chasing accounting students which are already enrolled as students in the CPA. Why is that? Because the CPA students and CPA members are not are exempt, are not part from the BC Employment Standard Act. So there's a BC Employment Standard Act that says that every employee, the working week is 40 hours, and every hours that you're working over the 40 hours is overtime. Unless you are exempt from BC Employment Standard Act, which CPAs member and CPA students are exempt from BC Employment Standard Act. What that means, working 10, 15, 14, 12, whatever hours you're working, you're not going to get paid overtime. That was so basically that's kind of interesting thing. Now again, going back to the previous accounting bodies, CA, CMA, and CGA, CAs was always exempt from BC Employment Standard Act. Why? Because they want that cheap labor, they don't want to pay overtime. End of the story. You work for me, you're my slave, I can do whatever you want. If you don't like to work in 12 hours, find another company, be my guest.
Okay.
CGA, in CGA, you can still, so CAs, those are the ones who work mostly public practice. CGA, they're also public practice, because with the CGAs, you can also do the public practice. CA wasn't happy with that, but they had to live with that. And the other thing is the CGA was part of the BC Employment Standard Act. So for that reason, most of the students, which they're graduating, were looking for CGA public practice companies because they actually get paid for the overtime that they have to put.
Okay.
Once the CPA become, which is much about those three associations, CA, CMA, and CGA, the first thing that they did, their first act, was to go to BC, the BC Parliament, and to request CPA to be excluded from the BC Employment Standard Act. This was the first act that CPA did.
Oh.
And they was right away excluded. And that gives them a lot of opportunities. Now they don't have to pay overtime. Now they can use you as a slave. So basically, if you are young, if you're just going out of the school, yes, you're eager, you want to do that. Obviously, you're paid $19, $20 per hour. You're working like crazy. But that's what is expected. Obviously, the turnover is high since those companies hire every year 120, 150 new employees. That means 200 employees already left. From the previous year that they hired 150, they're already gone. So that's why they hire a new one.
Yeah.
The turnover is ginormous.
Very big. Yeah. Turnover is big.
Is ginormous. It's just if you see the turnovers of those public companies, you're gonna get scared.
Yeah. Okay.
Right?
Right.
But that's the business. That's the business model that they have. That's the way they're doing the business, and that's always been there. So,
and that's very similar in Mexico too.
right. So the
Yeah.
question is, when you reach certain point of your life, do you want to go through this crazy environment?
No, I'm not. You already scared me. I
Right.
want to give up already. Yeah.
Right. Is it the question is it worth it? This is
No.
the other question. So listen, this is the other question. Is it worth it? If you ask me, here in this province, in this mentality, it does. It makes sense to me you to sacrifice 2, maximum 3 years of your life working in the public practice company while you're getting your CPA, So being public practice company, definitely strongly suggest you work on your CPA. On the same time, strongly suggest you. Once you get your CPA, see if you have any contractual agreement with the company to stay 1 or 2 years, right? Because what's the condition that they're putting is they saying we're gonna pay your CPA fee. Don't worry about it, and they paying your CPA fee. But there's different approaches here. One approach is whatever we pay, you have to pay it back, and we're gonna amortize this amount by that amount over the next 2 years. Make sense? That will be one approach. The other approach is we're going to pay what you're paying. We're going to keep track of this. 2 years from now, you have to work in the company. If you decide to leave, you have to pay back the entire amount or on the amortized amount, whichever it is. So now, how much is the CPA? Entire CPA, that's CPA, entire CPA, all the prep courses are around with the, so the membership fee will be excluded. So that will be 6 modules, put it 1,500, 1,700, 2,000 each, 6 modules, $12,000. $12,000. So now, then you have to do the simple math. If I'm working on the public practice company, you're gonna make like a $20, $21. That's how much will be that? That's 45, 40, less than $50,000. Once you get your CPA, with the 2 years experience in the public practice company, that's a different story now. Then you can easily jump on the $100,000. If you have a $50,000 increase in your salary when you make that transition, and you have to pay $10,000 for your outstanding fee, with the 50,000 increase in your salary on the first year, just pay them $10,000 and just move on. You already have that one. You already have it in your salary. So is it worth it? Definitely it's worth it. And if that's the goal that you have. I'm not sure if you were here. Was it with your group? There was someone, a Korean girl that came and talked to the students, but was it with your group or some the previous group? I can't remember now.
Not us.
Not you. But anyway, this Korean girl, so she was in Accender student. If I have to be honest, she wasn't the top student, right? She wasn't the top student. The top student, his picture was on the wall, but they remove it now. He's teaching in Alberta and working for Canada Revenue. He was a top student. So from that class, he became a CPA 2000. Tell me what now? 2020. 2020, he became a CPA student. She became a CPA 2023. September 2023. She became a CPA. That was, how can I say, a pleasant surprise for me when I saw her writing the CPA exams in the exam room, because we moved from the 2022, 2023, we moved from the online back to the in-person exam. When I saw her, that was a very pleasant surprise to see her writing the exam. Highly motivated. She was highly motivated. She's still highly motivated, and highly, how can I say, eager to prove that she can do it. That's a very strong motivation. And she did it. And she actually asked me to come and share her experience. It was very interesting for the students and for you to see actually a student from Accenda who, again, it wasn't the top student in the class, but she got the CPA. there are other top students from that class, the same class. Again, from that class, only 2 people become a CPAs. The class was actually 8 people. But anyway, 2 of them become CPA.
Nice.
Yes, that was very nice. That was very nice. That was very. Now I have another student, which is from the previous class, Gabriela Sharambaruco. I don't know if you remember her. She's from Brazil. But anyway, she is now in CPA, and but she's taking break because she just she had a baby, I think in January. Yeah, I saw her in December. In December, she was very high pregnant, and then she passed what she was taking, assurance, I think assurance, and she passed the assurance, and now she's on the schedule to take her core 1 and core 2, but now she's taking a break. Anyway, she's also from Accenda. That was from the previous 2 sections before you. So, can you do it? Absolutely. Absolutely. I can see at least 6 or 7 students in this class. You have to be CPAs. After that, so again, use that, talking about the public practice company and the experience with the audit. Use the public practice experience, go to the public practice company. So that's what this girl did. She went to the Manning and Elliott, I believe. She was MNP. MNP? No, not Manning and Elliott. MNP. She was working from MNP, public practice company. She working there for 2 years until she graduated, until she became a CPA. Once she became a CPA, she moved. She actually was working in the same building that we are on the 666 Barat. Up on the investment company, she was a business analyzer for $130,000 salary. Now she moved to US. She took equivalent exam. There's one transition exam that you have to make from CPA Canada to CPA US. She took it. Yes, she's passed, and now I think this January or last December she moved to US. Now she posted. I see some post that she's working now in Seattle. So is it achievable for you? Definitely, absolutely. But again, be smart here. Get the experience in the public practice company. Once the employer sees you with the public practice company experience, CPA with the public practice company experience, you are just easily transfer yourself on the level over 100,000 easily right now. With this market right now, with this how shortage of the accountants, of the good qualified accountants, $100,000 salary is very, very achievable from newly graduated CPA. Just graduating CPA, $100,000. The question is, do you want them? So now let's go with the generalized software. So that's why I'm telling you, it's a good thing. Yes, it's my personal suggestion is go for the public practice company if you don't mind taking the hit of the salary in the beginning. But if you make that kind of trade-off between gaining experience, going through CPA, passing the CPA, at the same time, because the environment that's created in these companies help you to get motivation to go to the courses, and then after that, future is in front of you. So let's see what are the generalized softwares. File the data access, which reads the extract of the data. Selection the operations. So we extract from that software, we extract select what exactly we're going to test. Then we're going to arithmetic functions, has the arithmetic functions to perform variety of the calculations, chasing variances, identifying which amount is material, which one is not material, how often that repeats, is there some amount that comes over and over and over again. So for that movie, if you watch the movie Accountant, the first part, how he come up with the idea of the randomly selected number, because of the random, when person randomly generate the number, he tends to focus on the one of the numbers which appears on all the amounts that he created. So that's another thing that the software can catch. Systematic statistical analysis, obviously various type of audit sampling. So which transaction I want to test, which one is the material, which one is the close to the material, and the report generators. After that's going to generate the reports, which is going to give you the outcome. Custom software is generally written by the auditor for the specific audit task. That software is very, how can I say, that's a very unique, and that exposes it, it's expensive, and then long-term development time, and it's very, very, very specific for the specific companies. So only when you're doing the audit of Apple or doing audit of Google, then you're going to create that software will be very specific and unique for that client, and you're always going to apply it when you're doing that client. But if you have that client for the contract for 20 years from now, that makes sense to do it. Test data is developed for the auditor to test the application control by the entity computer. And then we're going to get the data valuation, process of logic controls, arithmetical calculation. And now again, we're ending with the management responsibilities and require management of publicly traded company to issue reports. And also the management responsibility again repeated at the end. So we're going to the type of relating to the internal control of the financial reports, unqualified, signed by the entity. Internal control is designed and operating effectively. When we have a disclaimer, then the serious scope limitation exists, and adverse opinion is when there's material weaknesses identified. And this is how we issue the reports. So the likelihood, control deficiency, and significant deficiency, we issue in the unqualified report. Now the qualified report will be, again, we still have those significant control deficiency, significant deficiency, or even we may have a material weaknesses, but the management doesn't want to change them. Then we issue qualified report. But if you have only control deficiency, significant deficiency, we issue unqualified report. Why? Because there's not, again, for those deficiency, we're not informing the external users, only the audit committee and management. And the minor, so now with the effect, if the effect is minor, unqualified report. If it's more than minor effect, then we're going to disclaimer, or we may even withdraw from the audit. And those are some other reporting issues. And those are the audit requirements to communicate in the audit for the internal control financial reports. Let's quickly take a look at chapter 8 on the audit sampling. And I'm not gonna go over the entire chapter 8. I just want to see. Let's go quickly. What will be the key here? We're gonna talk about audit sampling here, sampling risk, confidence level, and tolerable and expected errors. So now we start talking about this audit sampling, and what will be the risk of incorrect rejection, incorrect acceptance. And then, as you can see, we're trying to identify any kind of risks that which can affect the audit. Let's see, testing only one of the few items on the IT system, type of the audit side playing. Then we're going more specific here on the attributable sampling, monitor unit sampling, and classical variable sampling. And which one is the what and how exactly we're gonna do. So again, we plan, perform, evaluate, document. Remember this, plan, perform, evaluate, document. Assess, test, gather evidence, assessing the evidence. It's always followed this kind of format. That's why, to some extent, audit is kind of repeating once you get the sense of it. I want you to, my objective in this course is, are you going to remember all this terminology? I highly doubt. Are you going to remember all those definitions? I highly doubt. But at least I want you I want to be able to build your basic understanding about the audit and the process that the audit takes, because once you understand that process, you can simply apply that process in everyday work. Assess the situation, gather the evidence. Are you actually right and wrong? Or what the findings that you think the risk is there, is it high, is it low? Assess the evidence, come up with the conclusion. That will be more, that will be very, 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 this idea here will be attributable sample examples. We're not going to go that deep on those one. That will be chapter 8. Let me see what's in chapter 9. So the chapter 8, I'm going to go very light on this. I want to see something more practical. Chapter 9 is about audit sampling and application sustains the test accounting balances. That's again with monetary sampling, and that's continuation of so basically chapter 8 and 9 going together. I don't think we're going to go over this too deep. Very, very light. I'm going to go to those chapters. Now we're going to the data analytics and assessing the sampling. Okay. Here we go. That's the interesting part. So I can easily skip chapter 8 and 9. I don't see anything important there. And we're going to start talking about processes. I want we to go over the processes. So that's where the focus will be after the midterm. So we're going to start with the revenue recognition. That will be more practical. And we're going to start understanding how we're going to go through this process of the revenue recognition first. Next one should be purchasing process. Yes. Next one should be human resource. Let's see if that's a human resource management, and keep going. So that will be my approach from now on. So let's see what was the chapter that we covered today. That was with the internal control financial reporting. So internal control financial reporting, that will be the starting point. And then we're going to move chapter 8 and 9. I'm going to skip those chapters And I'm going to jump directly to chapter 10, which we going to start with the audit of the revenue process. And if we have to take something from chapter 8 and 9 later, we can easily cover those one there. But I want we to cover the processes. So because if we cover the processes, then you're going to understand once we have those, again, we're going to start with the revenue. We're going to start with the next time with the purchasing, human resource, inventory, and the last one was financing. Those 5 chapters will be enough for you for the final exam. And if we have to do something more on the other chapters, we're going to do those one. I'm going to go over the other chapters. We're going to see what's more practical for you rather than just theory. Theory is a good thing, but at some point we have to stop with that one and start actual application. Questions?